The broadcast is now starting. All attendees are in listen-only mode.
Hey, good afternoon, everyone, and welcome to today's Sporting Goods Executive Review webinar. On the call today is Michael Blackburn, myself, and also David Silverman. We'll be going back and forth covering the various accounts. We're going to be providing a kind of a top-level review of the key operating and financial metrics of these sporting goods retailers we monitor. Before we jump into the specific accounts, I thought we'd take a quick look at retail sales and sporting goods sales in the aggregate. These are numbers reported by the U.S. Census. So looking at the June numbers, despite elevated inflation and eroding consumer sentiment, shoppers continue to spend in June, with retail sales rising a better than expected 1.1%. Again, these are aggregate numbers reported by the U.S. Census. The positive June sales came after a 0.1% decline in May. The spending was mostly broad-based. It was led by higher gasoline sales. They rose 3.6%, as the average national price for a gallon of gas rose $5 to $5. It actually rose above $5 in June. Since then, prices have receded somewhat. So if we strip out auto and gasoline sales, retail sales were up about 0.7%. Year over year, total retail sales were up 8.4%, or 6.6% excluding auto and gas. So this 6.6% included declines of 9.1% at electronic and appliance stores, and 2.9% decline at department stores, as we saw some mixed results in those two sectors. Compared to June 20 and 2019, all sectors were up double digits except electronics and appliances, which were up just 1.5% compared to June 2019. While we saw most retail sectors benefit from the pandemic shift result in a windfall in the sale of retail goods during the pandemic, the sporting goods sector arguably perhaps benefited the most in that consumers saw a huge surge in demand for fitness and outdoor activities. This windfall reversed the fortunes of a number of players, including Big Five, Academy, Sportsman Warehouse, and Camping World. So as a result, many of these players are now pursuing more aggressive growth. If we just look at retail sporting goods, and there's a 1-month lag in terms of the reporting, so we only have numbers through May. But if we look at sales in 2020, they were up 17%. Sporting goods sales in 2021 were up an even stronger 24%. So that was a real surprising result in 2021. Year to date, we are seeing a bit of a pullback with sales off 2% through May. So after struggling to keep stores stocked in 2021 due to the strong demand and the lingering supply chain constraints, inventory levels are now quite elevated, with first quarter numbers that came out a few weeks back. At the same time, we're starting to see sales are starting to pull back. As a result, we expect some margin pressure going forward from a more competitive promotional environment, combined with some of the ongoing supply chain issues, higher freight costs, higher labor costs, as well as the ongoing investments in all things that are digital sales, digital infrastructure. Meanwhile, the legacy issues remain for sporting retailers, including growing big box and online competition, manufacturers selling more direct to consumers, including whether it's online or through their own stores, and more major brands, which can often comprise 20% or more of a retailer's sales, pairing their partnerships with retailers, so focusing on some of the stronger players and kind of shedding their partnership with some of the smaller, weaker players. So these legacy headwinds are now combining with the consumer shifting spending back to services. So again, in 2020, 21, we saw strong demand for goods, a little less demand for services. Now some of that spending is going back to services. And at the same time, the consumer is dealing with inflation rising to levels not seen since the early 1980s. So looking at the inflation numbers, inflation started to spike in 2021, the spring of 2021. It's been above 5% since June of 2021. Initially, this reflected mostly strong consumer demand and pandemic-related supply chain constraints across many of the sectors and industries. So because of the strong demand for goods, retailers really had very little incentive to be promotional or discount their pricing. So that led to a lot of inflation. The rate has remained at or above that level since, while most economists had expected pricing to kind of tame in the second half of 2022. That was the theory coming into 2022, that prices would kind of, as we cycled the large increases in the second half of 2021, things would kind of normalize and spending patterns would normalize. What we're seeing is a sharp rise, particularly in food and commodities, and most significantly energy costs as a result of the Ukraine war. Now, most economists are predicting high inflation will linger at least through 2022. June inflation spiked to 9.1%, the highest rate since the early 80s. And again, led by a 42% increase in energy, while food costs are up 12%. If we strip out these more volatile food and energy categories, core inflation still increased 5.9%, led by automobile pricing, with many categories seeing a little bit more subdued growth, including sporting goods inflation of 5.3% and apparel inflation of 5.2%. Now, some inflation is good for retailers. Usually retailers like to see inflation in the 2 to 3% range. That kind of helps their margins and overall profitability. But it's obviously hit a tipping point. The consumer is still strong, but we are starting to see more changes in consumer behavior, particularly among low and middle income consumers, more of which are living paycheck to paycheck. So we're starting to see cuts in discretionary spending. So as you spend more of your money towards these essential food and energy costs, discretionary spending is being cut. There's evidence of trading down to private or cheaper brands, and also a general movement to mass superstore, dollar store, and discounters. And obviously promotions are picking up. So the question is, what's really going on and how long will it last? And it's really hard to tease out. We have a pandemic, a trade war, a land war, huge government spending, loose monetary policy. Both those last two factors contributed to too much cash in the economy. And also a global economy that's become vastly more integrated. That might be, all these combined makes it very complex for traditional economic theory to kind of explain what's going on right now and predict how long it will last. Then you look at the elevated margins across most companies that benefited from the pandemic, from shipping to energy through retail. Marginal profitability is up across the board. So looking forward, there's going to be a lot of kind of economic whiplash we expect in the next coming months. As retailers wrestle with a range of problems, many of them related to uneasy state of the economy. Household spending is increasingly strained, and real wage growth after inflation is now negative. So families are paring back purchases of non-essential items as prices for essentials like food and gasoline have become more expensive. The changes, though, to date at least, have been relatively uneven. We are seeing more people dining out and traveling more after missing the chances to do so early in the pandemic. The pent-up demand here is also fueling sales for automobiles, and some people, especially higher income households, are continuing to shell out for luxury items regardless of their elevated prices. So in this environment, to survive, retailers really need to be sharper, tie in their loyalty programs to be more effective, customized and personalized promotions. So in looking forward, those promotions are probably going to be more of a knife or scalpel relative to an axe that we might have seen in prior years. Retailers have gotten a lot smarter with managing their pricing and their merchandising, given the investments in digital that we saw in the last few years and even over the last decade. So to combat the higher inflation, the Federal Reserve Central Bank is raising interest rates and tightening the money supply. But this raises the risk of a recession. So it's kind of interesting that the Fed was very loose with monetary policy through 2021 because it wanted to avoid a recession. And now we may be forced to go into a recession anyway because of this environment that we're in and forcing their hand to raise interest rate. So the Fed is attempting to do what's called a soft landing, or cool demand enough to bring down inflation but avoid recession, fill existing job vacancies without significant job cuts, that we don't want unemployment to rise too much. But again, the situation is very complex and dynamic, and we haven't been very effective with soft landings in the past if we look at the history here. So with that as a backdrop, we'll start with the first slide with our retailers, looking at the trailing 12-month sales. So after 2 years of historical growth, retail sporting goods sales started to pull back during the first quarter. Sector leader Dick's added over $3.5 billion in revenues from 2021 compared to 2019. Trailing 12-month sales now are down about $200 million from the peak after they lost some sales in the first quarter period. We'll come back to Dick's in more detail in a little bit. We've also got a handful of some of the private companies that we do cover. Experiential shops like Bass Pro and Shields. Initially, they struggled during the pandemic, given their experiential concept, hands-on, service-oriented. But as stores reopened, sales quickly rebounded. Bass Pro sales have grown to over $8 billion, and we estimate Shields' revenue of about $2 billion. Again, both are private, and while Shields has historically maintained a stable financial structure, Bass Pro was more leveraged following their 2017 merger with Cabela's. Results had taken a turn south prior to the pandemic, with sales dipping to about $6.5 billion in 2019. And then obviously the pandemic fueled that strong rebound and added about $1 billion in revenues since then. The balance sheet, we believe, is much more improved, but we still estimate a somewhat leveraged capital structure. Within the sporting goods sector, golf and tennis were a couple of the handouts in terms of the categories that did very well, with more first-time players picking up both sports. So that was good news for golf and tennis. PGA Tour Superstore, we estimated their sales around $750 million. That was up from the golf boom, and also the company has been growing very aggressively, adding new stores. Worldwide Golf has also been benefiting. Last year, they completed an equity recapitalization. So they brought in Capitol Hill Group and a new president. One of the partners there at Capitol Hill, Ted Shin, is now the president of the company. That recapitalization did not result in any new debt or new funds to the company. We're still seeing sales continuing to grow. Now they're north of $300 million. They've also, their store count had been relatively flat, but they are starting to add store locations. Before we get to that, Dave, do you have any other comments on sales?
Sure, on a couple other companies, and good afternoon. So taking a look at Camping World, their sales increased due to higher selling prices for both new and used RVs. And we see that that's especially the case for the used RVs. It's very similar to the car market, where there was a lack of supply of new vehicles, and so the prices really shot up on used vehicles, and that is evident at Camping World. The company was also the beneficiary of COVID-era demand for recreation away from crowds. That now is beginning to fade, and they are being impacted by high gasoline prices and high interest rates, both of which make it more expensive to operate an RV. Academy, their sales also increased. They were really one of the biggest turnaround stories of the last couple of years. Their sales are just off of record highs. However, like a number of other companies, their most recent first quarter fiscal 22 sales are down due to lower comps. Taking a look at REI, they had about a 37% increase. The big improvement in fiscal year 2021, which is their recent year, reflects a rebound from fiscal 20, which was a very unusual year. And during that year, there was a temporary closure of the entire store base for about 6 weeks, and that occurred during the height of the COVID pandemic. So as we go through these, you're going to see a lot of anomalies, I guess, in REI, just because The last year was unusual, but some of the factors that continue to help REI in their revenue improvement, they have historically strong e-commerce sales, which constitute about 30% of their revenue. Their products are geared to outdoor activity, hiking, camping, such things like that, which were in high demand during the pandemic. And their customer base is intensely loyal. So it would take a lot, to pry them away from their long-standing relationship with REI. And that's one of their natural barriers to price competition. Callaway had the biggest year-over-year increase. That was due to the acquisition of Topgolf in March of 2021. Topgolf operates open-air golf and entertainment venues, and that acquisition was really transformative because Topgolf is growing rapidly. And essentially what they did is they combined Topgolf's services with Callaway's more traditional equipment and apparel sales. Taking a look at Varsity Brands, they operate through 3 divisions, all of which are tied to schools and team sports. The BSN Sports unit distributes team sports equipment and apparel. Varsity Spirit provides cheerleading uniforms, and Herff Jones supplies class rings. Most of their sales improved, and they were driven by a recovery in team sports. In addition, the company continues to acquire local dealers who have established customer bases. So ultimately, we believe that Varsity Brands has recovered most of the sales that were lost during the pandemic when schools were closed. One ongoing concern with that company is that they are very highly leveraged from 2 private equity buyouts that have occurred in the last few years, and also ongoing acquisitions of smaller dealers. Hibbett was actually the only company, I believe, to show a decrease. The lower sales were due to a lack of inventory due to supply chain constraints. They had lower comps, but that was partially offset by some store openings. The big problem with Hibbett is that most of their sales are in apparel and footwear, which are very competitive, and these are niches where there's going to be a lot more promotional activity, and also apparel is seasonal, which was one of the problems they had. Big Five trailing 12-month sales were up, but they were down for the most recent quarter due to lower comps, and they are one of the companies that lacks pricing power. We're going to get into them a little bit in more detail as they are a spotlight company. Dunham's Athleisure, their sales were up due to the general reasons, increased industry-wide demand, last year's stimulus, and the lack of promotional activity. Dunham's is one of the retailers where Nike ceased direct shipments in 2021. It's kind of unclear of the impact because we don't know exactly how much of Dunham's business comes from Nike. Just some ongoing issues surrounding Dunham's. Number one, they have a minimal e-commerce presence in a world where e-commerce is becoming more important. They have a high concentration in apparel and footwear, which, as we said, are among the most competitive categories. And that means that they're more susceptible to encroachment from online retailers. But probably the biggest redeeming quality of Dunham's is they have and continue to have a very strong balance sheet. And if we want to go to the next slide, I will start off on store count. Just looking broadly at this slide, all the companies increased, although the changes were not very big. And the reason is most of the companies have been very conservative during a period of volatility. Obviously, they're trying to preserve cash. Hibbett continues to have the most stores in total, but they have very moderate sales per square foot. It's only about $240 per square foot. That ranks them as the second lowest. They operate through 3 different banners, Hibbett stores, which average about 5,800 square feet and are located in strip centers and enclosed malls, usually near a Walmart. City Gear was acquired in November 2018. Those stores average about 5,000 square feet, and the Sports Edition stores average 2,800 square feet, and they're primarily in enclosed malls. Excuse me. Big Five opened 1 new store. Their stores average about 11,000 square feet. The store base has been relatively stable over the last 5 years. One of their issues that over half of the Big Five stores are in California, where there's a lot of competition from Dick's. Just about 67% of the Big Five stores overlap a Dick's store within 10 miles. Academy, their stores are typically located in high traffic shopping centers. They range in size between 40,000 and 130,000 square feet, and they currently average about 70,000 square feet. There's a considerable overlap with Dick's stores. Dunham's opened 6 stores. They've been expanding for a number of years. The rate of growth has slowed a little bit recently with Dunham's. In terms of overlap, about 30% of the Dunham stores overlap at Dick's within a 10-mile radius. Their stores range from a low of 5,000 square feet to over 100,000 square feet. And the reason for that is that they acquire their stores opportunistically based on market availability. Essentially, they snap up bargains when other retailers close their stores. Callaway had a pretty big expansion. That's obviously due to Topgolf venues, which are expanding and are expected to continue to grow. They plan to open at least 10 new venues in the current year, although they're going to be heavily weighted toward the back of the year. Any comments there, Mike, on this slide?
Yeah, as Dave mentioned, pretty conservative overall in 2020, and then things started to pick up a little bit in 2021. Dick's' store count is up in net 3, and they're continuing to open a handful of locations, including some new formats. We'll get into that a little bit more. Sportsman Warehouse, one of the accounts that we were concerned about before the pandemic, they're now opening 10 stores this year and plan to open, it's 5 to 10, or grow their square footage by 5 to 10% over the next few years. That's at least 6 to 12 stores a year. I mentioned PGA Tour is growing. They plan to add another 8 stores this year. Worldwide Golf has added 3 stores year to date. One of the biggest increases, obviously, was Fleet Feet, and that included their acquisition of those 56 Jackrabbit stores from Intero Brands, or previously known as Running Specialty Group. And that business is obviously noticeably absent from this store count chart. We've been covering Intero Brands. That's their unofficial name. Their official name is still Running Specialty Group. We've been covering them extensively since 2020, early 2020, when we started to see their slow payment trends and payment issues going on with that business. Since then, the payment trends really never improved. At the same time, they've been divesting assets. They sold the Jackrabbit business to Fleet Feet. They divested the shoes.com domain name to Designer Brands. And as we've been covering this year pretty extensively, they've been closing those Olympia Sports stores. They came into the year with just over 60 stores. And Olympia Sports they acquired back in 2019. At the time, they acquired 75 locations. The chain had closed the other 60-odd locations. The company had been as big as 200 stores just a few years back. And that company was having its issues even before under the ownership of Running Specialty Group. And we've been concerned about that investment ever since it was announced, and for good reason. Because as we've been covering last week, they announced they are going to be officially liquidating all their stores. We had already been reporting about speculation about that prior to. The current situation is that they retained legal counsel, and they're considering their options in terms of how do they get out of this mess, whether it's a bankruptcy filing or other means to continue the liquidation. But if this is a situation you're not familiar with and you'd like to talk more, definitely feel free to reach out to me after this call and we can discuss it.
So now we will take a look at our first spotlight, which is Academy. As we said before, Academy was one of the biggest turnaround stories in the last couple of years. They benefited from increased demand during the COVID period. If you look at them at the beginning of 2020, they had a very highly leveraged balance sheet, and they faced the pending maturity of about $1.4 billion in LBO debt that was scheduled for last month. And I remember keeping an eye on that for a number of years, looking at that July 2022 date, which really did not materialize. But there was an incredible operational turnaround there. Sales, profitability, and cash flow all benefited from increased demand for sporting goods. And because of that, they were able to complete an IPO in September of 2020, and they used the proceeds from the IPO and also proceeds from the issuance of new debt to repay the entire $1.4 billion LBO term loan that they had. You can see the benefit of the new capital structure and also their operational enhancement in the ratio of debt to TTM EBITDA, which improved to a very strong 0.7 times in the first quarter of 22 from a very highly leveraged 5.3 times back in the first quarter of 2020. The improvement in EBITDA margin also highlights the rapid recovery. Academy's TTM EBITDA margin more than doubled to 15.6% in the first quarter of 2022 from only 6.2% back in 2020. During the pandemic, their e-commerce sales increased to about 10% of revenue from 7% pre-pandemic, which obviously helped them, but e-commerce remains a competitive weakness of Academy's. Their increase was nowhere near the increase that occurred at a lot of their competitors. They are still below Dick's. Dick's, I would say, is about 20% of their sales is e-commerce. Dick's has a much more sophisticated website and inventory system, and Dick's has consistently outspent Academy on IT matters. Academy sales peaked in the fourth quarter of 2021, but if we look at the first quarter of 2022, sales were down 7%. Nevertheless, they still remain 36% higher than the pre-pandemic period of 2019. Same thing happened with gross margin. It fell in the first quarter of 2022 on a year-over-year basis, but it remains about double the pre-pandemic levels on a TTM basis. So the point is that Academy is really now at somewhat of an inflection point after hitting historical highs in both sales and margins. One of the things they're doing to help their margins is they've increased their concentration of private label. Management has increased it to about 20% of the mix. And one of the reasons is private label is more profitable than branded products. It fills in gaps in the product mix that are not occupied by national brands, and it appeals to cost-conscious consumers. Obviously, in today's inflationary environment, that's very important. Turning to the store base, excuse me, Academy had a moratorium on store openings during 2020 and 2021, and in 2022, they're now returning to their pre-pandemic expansion pace. The plan is to open at least 8 new stores in the current year and 20 stores annually starting in 2023. So that means about 80 to 100 stores over the next 5 years, and that implies an annual growth rate of between 6% and 7%. The new units are going to be a little bit smaller than the existing ones, about 55,000 to 60,000 square feet, That's a little bit below the current 65,000 to 70,000 square feet that is the average. Obviously, there's a risk in expanding, especially during this period of time. The ramp-up costs associated with the expansion are unmatched by revenue during that period, and that creates another potential drag on cash flow. Academy also has a problem that is common to other retailers these days, and that is higher inventory levels. Inventory was up 22% at the end of the most recent quarter, and that led to a decrease in free cash flow. Management said that inventory was up only 9% over the first quarter of 2019, which they believe makes it at a much more normalized level. However, we note whenever we see these higher inventory levels that there's a risk that the higher inventory can lead to margin compression. And that's especially so in this time period when consumer demand is falling and the selling environment is becoming more promotional. So looking ahead, there is operational pressure on Academy. As we said, the excess inventory at a time when consumer demand is down, manufacturers selling direct to consumers. They have that risk now associated with their more aggressive store opening program. And about 40% of their stores are located in Texas. Sometimes that raises concerns over geographic concentration. But the good thing about Academy is that entering this very uncertain period, they're in a strong position. They have a healthy balance sheet, no debt maturities until 2027, and they have very strong liquidity. And Mike, if you want to flip the slide to comps, I can start that. So this slide is comparable store sales, which essentially it provides an apples to apples comparison to stores open last year. And it's better at gauging sales trends than total sales because it removes the impact of store openings and closings. Now, the thing to note that this slide, this is a year-to-date slide. This is not TTM like most of the other slides. And in terms of the year-to-date, it's essentially one quarter, and that's the most recent quarter. And to highlight what's been going on, if you look at the average, you can see that the current year average is negative 9.4%. Last year's average was 57.7%, which is really incredible. All of this highlights the fact that we are now in this industry at an inflection point where we've had very strong results for the last couple of years, and because the economy is starting to change, the industry is changing, and sales and a number of other metrics have now started to fall off. Most of these companies were up against historically high comparisons from last year. Essentially, they're lapping what are unstable comps. And so comps were down at all companies, as you can see in the slide, and they turned negative at 5 of the 6 that we show here that reported their comps. If you look at Camping World, they were down, they were not negative, and this is because of slowing demand for outdoor recreation due to the high prices of recreational vehicles, especially used vehicles, and also high interest expense and higher gas prices. Academy was down 7.5%. They were up against 39% comps the previous year. And for the rest of the year, for the full year, management expects comps to be negative 6% to negative 3%. Hibbett had an 18.9% decrease in comps, and that follows a very tough comparison with their 87% increase at the same time last year. And one of the issues at Hibbett is that their sales were hampered by an uneven flow of inventory. A number of their seasonal items were received too late in the season, in the winter season, and they couldn't be sold, and they were carried over to next year. And management said that they expect negative comps in the second quarter, with the possibility of higher comps in the second half of next year. Did you have any comments on that slide, Mike?
As Dave mentioned, the results from the prior year were unsustainable. So seeing these negative numbers certainly was expected. Dick's, the sector leader, was down 8.4% on top of an 115% increase in the prior year. But the result was worse than expected. They attributed to rising inflation and the impact on consumer discretionary spending. And that led them to lower their guidance for the rest of the year. Sportsman Warehouse was down 12%, and that was their second consecutive negative comp performance. They're highly exposed to the hunting category, represents over 50% of their revenues. We saw a huge influx of gun buyers during the pandemic. There were some 15 million new customers or first-time buyers of guns during the pandemic. And that's a highly cyclical business, so we do expect more tougher, even higher, increasingly pressures on sportsmen relative to the rest of the sector players because of their exposure to firearms. So looking at the next measure, we have gross margin, which reflects your gross profit or your sales minus your cost of goods sold, which is primarily your inventory levels. Gross margins across the board remain elevated, but there is growing risk that gross margins are on their way back down. We have expected the normalization of sales and now inflation, including higher freight and transportation costs, and larger macroeconomic headwinds are growing. These are going to challenge even the latest downward company guidance revisions that we've seen. Another concern is the sharp increases in inventory levels that Dave was talking about, and that's across the sector. So assuming demand does continue to wane, promotions and markdowns are expected to further pressure sales and profitabilities going forward. Online sales is another consideration. It largely retreated in 2020 from their highs in 2020. They retreated in 2021 from their highs in 2020, but they are expected to pick up more modest pace of growth in 2022, which will also have some pressure impact on on gross margins as well. So in terms of higher inventory levels, again, Dick's inventory was up 40%. They did say we're still chasing product, but it is very elevated. Their first quarter gross margin was down 80 basis points to 36.5%. Their merchandise margins, actually, if you just strip out that portion of the portion of the gross margin, that was stronger, including a growing mix of private brands, which represented about 15% of their dollar sales during the quarter. That was more than offset by the inflationary pressures and higher supply chain costs. Their gross margin on trailing 12 months, as you can see here, is 38.2%, and that compared to about 29.3% in fiscal year 2019. So it's still a very strong margin. Sportsman Warehouse gross margin have been falling in 2021, but now with the hunting and firearm sales mix kind of slowing and that representing a less representative of the total sales mix, that's a lower margin business. So their margin's actually ticking up a little bit. It was up 20 basis points in the first quarter period. TTM, it's 32.6 gross margin, and it's down about 40 basis points year over year.
Yeah, just to comment on a couple others. Callaway had the largest increase on that slide, but it was really because they introduced the Topgolf, which is a service, and services are more profitable than the traditional sales of products at Callaway. REI is traditionally one of the higher gross margins in the industry. Part of the current period improvement in gross margin was due to the fact that there were more sales that occurred inside stores in 2021 as compared to 2020, when there were a lot more internet sales, which is less profitable, and that's because their store base, as I said before, was closed for about 6 weeks during 2020. Let me see. Yeah, and I guess just looking ahead, I think we're going to see some fluctuations here, especially because most of these companies do have the higher inventory levels at a time when the demand is falling. And if you want to flip the slide, I can start SG&A. SG&A margin evaluates the relationship between sales and operating costs. And so on this chart, lower numbers are better because they're expressed in terms of the expense component. SG&A margin deteriorated for most companies, meaning higher numbers. The primary reasons are higher investments in digital and also increased labor, rent, and other overhead costs. REI was the only one actually that improved, and this again is because of part of their anomaly. They were up against very easy comparisons in 2020 when their revenue fell, but their fixed costs continued. Academy was largely unchanged, and that's partially because they didn't open any stores during this period, and that kept their costs down. But looking ahead in 2022, their SG&A costs could escalate as they go back into expansion mode and they incur a lot more startup costs. Callaway had a much higher ratio, and again, that's because the Top Golf unit is much more labor intensive than the traditional Callaway business. And looking ahead, we expect to see a lot more pressure on SG&A margin going ahead.
Right, but the one kind of put a point of comparison. Dick's first quarter SG&A margin was up 210 basis points to 19.7%. Their TTM margin was a slightly better 19.2%, but that compared to a 20.7 SG&A margin in 2019. So it's still about 150 basis points improved. I talked about it. Sportsman's gross margin was stronger, but their SG&A margin was much weaker. They lost leverage with the lower sales levels, and they're also investing more in marketing and labor and the new stores that they're opening. That's deteriorating their margin overall. Their SG&A margin in 2019 was 27.1%. So in terms of profitability, we've always liked to look at EBITDA, or earnings before interest, taxes, depreciation, and amortization. So that's your sales minus your cost of sales, so it gets you your gross profit, and you minus your SG&A costs, and then you add back that non-cash depreciation and amortization expense. Then you put it over your sales level to get a margin, so it's more comparative to your peers and kind of tracking it from period to period. And as you can see, still highly elevated. We are seeing some of these numbers start to slip, but for many of these companies, their EBITDA margin during the pandemic more than doubled. Dick's Sporting Goods is one example. Their margin had peaked near 20%. It's now starting to come back down. It's at 19% after the first quarter numbers. Sportsman Warehouse is also coming down a lot more sharper. It's down to 8%, but that's still up from an EBITDA margin of about 6.4% in fiscal year 2019. Their first quarter EBITDA itself was down around 50%. Dave, you got any comments on EBITDA?
Yeah, just one quick one there. I think you touched most of the points. Hibbett was down significantly, and one of the reasons is both their gross margin and their SG&A margin deteriorated, whereas a lot of these companies, it was just one or the other, and there was a little bit of an offset. But when both of them deteriorate, then it really becomes magnified when you look at EBITDA margin.
Right.
And just one other thing, on Big Five, you see that they're looking fairly nice at 11.9%, but we have to look at where they were pre-COVID. They were only 2.6% pre-COVID. They were one of the companies, as we say, the rising tide lifts all boats, and they were one of the ones that kind of went along for the ride. But they have some significant problems that will probably become more evident as the economy normalizes.
So as we see sales pressured, gross promotions returning, and costs rising, these numbers will come down in 2022. However, given the guidance, of most of the companies, including Dick's, we still expect the margins to remain elevated relative to the pre-pandemic period. So taking a little closer look at Dick's Sporting Goods, this is the only true national sporting goods chain. They've got 850 stores. That includes 729 of their legacy Dick's stores and a growing base of specialty stores, about 129 locations. They capture 2/3 of the U.S. population and about 10% of the sporting goods market share. So there's still a lot of consolidation that they can continue to pursue, and they are doing that. They're adding new locations. It's starting to pick up a little bit. In 2021, they actually opened 14 stores, including a number of new formats. They also closed 7. They're expecting to add about 11 new locations this year. And that's going to be a mix of legacy and these new formats. So the new formats are kind of in a test phase, and they're across the board. The higher end formats like the public lands, which is an outdoor focused format, closer to, say, an REI. And then there's their store of the future, the House of Sports, which are very large experiential concepts. They've got running tracks, climbing walls. So these are locations that are really more in a test phase for the company. Public lands is a format they're a little bit more aggressive about in terms of opening, but I think they're still very much in House of Sports, being like a test ground for different concepts that they might roll out to their legacy stores, that concepts that kind of work, they'll roll out to those legacy stores, and haven't really seen a big push to grow those House of Sport formats. On the other end, they've been growing their outlet formats, which has been a really effective means for them to kind of help with their clearance item, to move out some of their clearance items. Instead of leaving them in the legacy stores, the Dick's stores, taking up space, they take the merchandise out, put in new merchandise, and then move the clearance merchandise to these outlets. So that helps them on a margin perspective, keeps their store fresh, keeps sales trends, store traffic up, and overall, it's going to be helpful in terms of maintaining some of the margins that they've grabbed over the last couple of years. E-commerce has been a focus of growth, as well as private brands. E-commerce had topped 30% in 2020. It came back down to around 21% of sales in 2021, and we expect it to hit closer to the mid 20% range for 2022 as it continues to grow overall. As we mentioned, first quarter comps are down 8.4% and margins eroded. EBITDA itself was down 21%. But as you can see in this chart on the right, from fiscal 21 to 2019, they added over $3.5 billion in revenues. They gave back around $200 million during the first quarter, and they'll give back more of those sales during the rest of 2022. But we do expect these numbers to be elevated, even though they lowered their guidance for comps to fall 2 to 8% for the full year of fiscal year 2022. So TTM sales and EBITDA are up around 38% and 300% compared to fiscal year 19, and again with that 19% EBITDA margin compared to a mid 8% margin back in 2019. So they're still doubled the marginal profitability. There's plenty of cushion to absorb any headwinds going forward. As I mentioned, the first quarter inventory was up around 40% versus the first quarter of 2021. That was over an $800 million increase. They carried just over $2.8 billion in inventory on their balance sheet. So that is pretty elevated year over year, even considering the normalization of sales trends. So again, margin pressure that, given the headwinds with the overall inflation and consumers cutting their spending, we think these elevated levels, they reflect, the challenges that the supply chain issues have kind of thrown at retailers over the last couple of years in terms of trying to figure out how do you manage your inventory? What type of products do we need in our stores, and how long do we need to, how do we order them? There's been an expanded lead time in terms of how long they need ahead of time they need to place these orders, and at the same time, then you're seeing the consumers shift their buying behavior. Notably, in the first quarter, in apparel, we saw a big shift away from casual towards more luxury and dress wear categories in department store and apparel categories in general. So this shift away from casual wear probably is going to be hurting some of these sporting good chains, including Dick's, going forward if that trend continues. So cash flow has been falling a little bit, but it's still strong. They're still generating over $1 billion, or they generated about a $1.3 billion in free cash flow during fiscal year 2021, and it came down a little bit in the current period, but it's still quite strong, and that allows them to kind of pay dividends, rearrange debt. And the interesting thing, though, is coming into this year in January, they issued $1.5 billion in debt. Now, they had maintained a virtually debt-free balance sheet throughout most of the pandemic, and I guess they saw the writing on the wall with the expected increases in interest rates that we've seen. They went out and issued debt, locked it in at a lower rate. They're using that to repay some of their existing convertible debt, and also just to boost their cash balances and reinvest in the business overall. So they're in very strong, stable shape, and that leads to their A2 credit rating. In terms of capital expenditure margin, which is your capital expenditures, the amount of money you're investing in the business, divided by your sales, general gauge, most retailers spend at least 1% of their sales reinvested in capital expenditures. Anything below 1% generally we think is inefficient, or they're not reinvesting enough in the business. 1%, they're just basically doing a lot of the basics in terms of keeping their stores fresh, changing light bulbs, fixing things as they break and things of that nature. Generally, these have been relatively tame, again, except for Topgolf. We're starting to see these numbers pick up as the stores kind of reinvest in brick and mortar, but also most of the focus had been in the last few years on digital infrastructure investments, investing in omni-channel capabilities, and growing their e-commerce business. So, we are expecting this to kind of pick up a little bit. Dick's itself is going to be opening 11 stores, and they're increasing their capital expenditures by about $100 million this year. But obviously, they've got plenty of cash flow. Sportsman Warehouse is an account that we're a little bit more concerned. Again, they're opening about 10 stores this year, and they're generating negative free cash flow at this point because of their lower earnings and their increased investments and the rise in their own inventory levels and working capital levels. So that's a little bit of a concern. Dave, you have any comments on CapEx?
Not on that, no.
Okay. So just looking at the sporting goods stock index, most of these stocks really just kind of took off. You take a company like Big Five that was trading in the single digits. Their 52-week high was around $48 a share, dropped around a low of about $10. It's down 44% year over year, but still relatively elevated compared to where they were pre-pandemic. Dick's Sporting Goods, their stock price had dropped as low as $15 during the pandemic. So if anybody was smart enough to buy that stock early on in 2020, they probably had a nice windfall. The stock rose into the mid $100 range, and then it gave back a lot of ground. It's down around 9% year over year. So overall, most of these stocks are down. Academy completed its IPO in late 2020. I think it was about $18 per share. The stock rose significantly. I think it got as high above $50 at one point. And then it trailed back down to around $35. Recently, it's gotten some stock investor interest, and the stock has ticked up around 19% in recent weeks to the mid $40 range. So still relative valuations of equity up significantly since the pandemic. In terms of cash flow, again, in 2021, most of these were positive except for REI, given the issues that Dave had discussed previously. And as we've been speaking about the rise in inventory levels, the earnings pressure, that is seeing these numbers trail off significantly, with a number of them turning negative, including Callaway, Camping World, and as I was talking about before, Sportsman Warehouse. So we're now in negative territory for a number of these companies. So this is certainly something we would need to watch out for. But given the pandemic windfall, all these companies are in much stronger financial footing than they were pre-pandemic. So they certainly have some time to kind of watch this. But as the rest of 2022 plays out, 2023 will be a critical year for a number of these accounts. We'll be obviously watching them very closely. Big Five is one of these accounts, and Dave's got a little bit more detailed comments on what's going on situation with Big Five.
Sure. So Big Five is a regional sporting goods retailer. They are located on the West Coast, predominantly in small towns away from larger competitors. It's the hit 'em where they ain't strategy. They sell apparel and footwear, some guns and ammo, extensive competition with Dick's, mass merchandisers, Amazon, and the department stores. Competition has increased in the market area, especially in California. Over half of the Big Five stores are in California. As I said before, there's a 67% overlap of Big Five stores with Dick's stores within a 10-mile radius. The big issue is the significant concentration in soft goods, footwear and apparel. Together, they constitute about 90% of the product line. And the product line is considered to be low to moderate quality. One of the concerns is that there have been frequent comparisons between Big Five and Modell's. And I'll just touch on a number of these, both of them with a minimal e-commerce presence, both with a high concentration of soft goods. Obviously, the competition from Amazon and Dick's, the significant store overlap with Dick's, both of them had that. The product line, low to moderate quality, they both lack purchasing power. Consumers will not hesitate to jump to a competitor when price is the issue. Both have historically low EBITDA margins. Modell's, before they filed for bankruptcy, was less than 1%. Big Five, before the pandemic, obviously Big Five is a very nice EBITDA margin now. Before the pandemic, Big Five was 2.6% on their EBITDA margin. Both had minimal private label exposure. They both, with high geographic store concentration, Big Five mostly in the San Francisco and Southern California area. Modell's was mostly in New York City, and both companies had seasonal sales that were impacted by the weather. And if you had a warm winter, there'd be a lot of carryover inventory. Some of Big Five's current operational problems is that their comps were down in the first quarter of 2022, and the quarterly sales are already slightly below pre-pandemic levels. In fact, they were the only sporting goods company that reported quarterly sales that were below 2019 levels. Most of the other companies were up by double digits over 2019. So they are already starting to come back to earth. They also have the lowest sales per square foot among the retailers, the sporting goods retailers that we cover, about $210 per square foot. That's lower than Hibbett, which is $240, and it's certainly below Dick's, which is $270 per square foot. Again, the high inventory at quarter end, the most recent quarter end, was up about 18%, and they were negatively impacted by the high carryover of winter-related inventory. As I said, they received the inventory too late in the season to sell it through. And like I said, that is one of the similarities to Modell's, is that carryover issue. Despite the operational problems, they currently have a strong balance sheet. They don't have any near-term debt maturities. They currently have a B2 credit rating, but you're going to see it on the other side. Well, you're not going to see this on the other slide, that their credit rating was D2, dog 2, prior to the pandemic. And that's something that we're going to keep in mind as conditions start to normalize and the industry-wide surge in demand begins to fade, and it will start to impact Big Five. If you want to flip it to the next screen, I can start that. Percent availability is the availability under the revolver. It's a measure of liquidity. Liquidity is availability plus cash, and availability is the largest element of liquidity. One thing to keep in mind is when companies have low borrowing availability, they may try to compensate by stretching payables. And in some cases, we've seen this in the past as they try to use vendors as a bank. As we can see, obviously, most companies here are okay. Just on a technical point, availability is also impacted by the borrowing base. And in these current times where supply chain constraints are an issue, that can lead to lower inventory, and that can lower the borrowing base. And ultimately, a low borrowing base may limit availability and liquidity. So that's especially true in these kind of unusual times with supply chain constraints. Did you want to add anything to that, Mike?
Yeah, I mean, the lowest number we've got there is Sportsman Warehouse, 32%. So they've been tapping their revolver. They borrowed just about $112 million, through the first quarter period. It's a $250 million facility. It doesn't mature until 2027. But subsequent to quarter end, they had another $100 million in availability. They increased the revolver to $350 million. However, given their borrowing base, we don't think they're going to have access to that full $100 million additional liquidity. So they've got about 110 million available at the end of the first quarter before the increase in the revolver, plus around $57 million in cash. So even though they are burning cash, we do anticipate they should have enough liquidity to at least get through 2022. But then going into 2023, that'll be a much more critical year for this company. The next two slides are what we consider probably the two most critical ratios for a credit analyst. The first being the debt to EBITDA, where you divide your debt by the amount of EBITDA that the company is generating on a trailing 12-month basis. It gives you an idea of how much flexibility the company has to refinance their debt if they needed to. Obviously, with debt being the numerator, you want as small as number as possible. And the reason this is such an important measure, we always say, is anytime that number starts to track above 3 to 4 times, regardless of the type of company you're looking at, that's a warning sign that the company has too much debt, or maybe it's not generating enough EBITDA, or maybe it's a combination of both those factors leading to that high debt to EBITDA number. And as you can see, all the numbers in our universe are under that key metric, and they've come down significantly. You could take a company like Academy. When they were private pre-pandemic, we were estimating their leverage ratio or debt to EBITDA was north of 4 to 5 times. So they were highly leveraged, had over $1 billion in debt. And now they have a much more comfortable leverage ratio below 1 times. Same thing with Sportsman Warehouse. Dick's number has increased significantly again because of that debt issue that they completed. They issued $1.5 billion in debt. But even with that, their leverage ratio is still very strong. Given the declining cash flows and declining EBITDA, these numbers will tick up in 2022, and we'll continue to keep an eye on them. I would take into consideration particularly Camping World with their exposure to the cyclical RV business. That's been ticking up as they've become much more acquisitive in recent periods as a result of their strong operating results, but they overbite or they bite more than they can chew. That number could creep up above that red line in future periods, and if operations start to deteriorate, that's certainly an account that we want to pay close attention to as well. The next one is interest coverage, which is now your EBITDA, the numerator, divided by your interest expense, or how much cushion do you have, how much profit do you have to make sure you're paying that interest obligation each year. And obviously here, the higher the number, the better. But again, the red flag is anything below 3 to 4 times. So it's still in that 3 to 4 times range, but it's anything below that. And for the most part, we're in pretty good shape here across the board. Hibbett is off the chart because they have very little debt and interest coverage immaterial. REI, the same thing. They had no interest expense. Dave, did you have anything to say?
No, I think we're good.
Okay. So again, we expect these numbers to kind of fall back in 2022. But again, there appears to be currently plenty of cushion here, barring any disastrous impacts from most of these players. And then, finally is our credit rating, which is an aggregate of all these factors, as well as some judgmental factors on our part in terms of our outlook on the company. And for the most part, everybody's in pretty good, either in satisfactory C rating category and good B rating category, excellent A2 rating for Dick's Sporting Goods. And this reflects any credit rating changes over the last 6 months. Sportsman, again, we did downgrade to the C1 rating. Possible that we see more downgrades for them. Given Dick's outlook, I would also expect that they could possibly be downgraded into the B range, but again, that's still a solid B credit rating. And we could see other credit rating downgrades, again, because of the pressures that we've been talking about throughout this call. So with that, that's the end of our prepared remarks. If anybody does have a question, feel free to type it in. We could hang out here and address those questions right now. If not, feel free to get in touch with me or Dave with any questions. And again, if anyone wanted to talk more about Fleet Feet or Intero brands and what's up with Olympia Sports, I'd be happy to take your call. We could discuss that in a little bit more depth to get our perspective on what's happening there. But we want to thank everyone again for participating. And if anyone has any feedback or comments, please, again, also send those our way. We'd love to hear from you. Looks like we have no questions, so I want to thank everybody again and hope to talk to you all real soon.